Welcome to this explainer. Today, we're diving straight into the hard data to understand how global trade is fundamentally being rewritten, literally right before our eyes. We're looking at some fascinating research from the Bank for International Settlements, along with insights on emerging global trade trends, to unpack exactly how the world economy is shifting right beneath our feet.
So, let's kick things off with a pretty massive question. For decades, the story of the global economy has been this almost unstoppable march toward total integration, right? But with recent trade wars, pandemics, and rising geopolitical conflicts, a lot of experts are asking, is the world actually retreating from all that interconnected trade? Are we officially entering an era of deglobalization? Well, before we can measure that retreat, we really need to look at the massive empire of trade we've built up over the last few centuries.
To really grasp this, we got to rewind a bit, because global trade hasn't always been this smooth, cooperative venture. Back in the 17th and 18th centuries, the mercantilist period was, well, pretty much anarchic. It was a zero-sum game. Colonial armadas, pirates, and constant warfare as leading powers tried to hoard all the wealth. It wasn't until around 1870, with the Second Industrial Revolution, that things calmed down into a more liberal international order, mostly thanks to massively reduced transport costs. Fast forward to 1969, information and communication tech totally accelerated global integration. And that brings us to today. Since 2011, we've been in the Fourth Industrial Revolution, which is all about these hyper-complex, digital, cyber-physical systems that connect the globe in literal milliseconds.
And let's be real, this centuries-long journey, it was insanely lucrative. Over just the past 5 decades, global economic output absolutely skyrocketed. We went from $29.3 trillion in 1970 to an astonishing $174 trillion by 2022. Just to put that into perspective, that is a staggering explosion of wealth. And it was entirely driven by one main idea, that free-flowing capital and goods across borders was the ultimate engine for global prosperity.
Okay, that brings us to Section 1, Politics Fractures Global Trade. Recently, that massive growth engine hit a major roadblock. Economists at the Bank for International Settlements are actually tracking this shift using something called geopolitical distance. Basically, by analyzing United Nations voting records, they've created this incredible data-driven heat map of global allies and adversaries. As you can see, lighter colors mean close political alignment, while the darker red shows geopolitical adversaries. So countries within the European Union are super close to each other on this metric, whereas the US and China are geopolitically distant from many other nations.
Which brings us to a term you are going to hear a lot going forward: geoeconomic fragmentation. Historically, international trade was all about comparative advantage. Countries traded with whoever offered the best price or the fastest production. Geoeconomic fragmentation is what happens when countries start making their trade and investment choices based on political alignment rather than market efficiency. It's essentially when that UN voting alignment we just looked at starts directly dictating where global cargo ships actually sail.
And the actual, quantifiable impact of this is wild. Researchers looked at trade data across 5,000 specific sectors, and they found that between 2017 and 2023, trade volumes grew 2.5% more slowly between geopolitically distant countries compared to aligned ones. And yes, that's after mathematically controlling for normal supply and demand. Now, 2.5% might sound like a drop in the bucket, but spread across 5,000 global sectors, we are talking billions upon billions of dollars in lost trade. Countries are actively, intentionally pulling back from trading with their political rivals.
Let's look a bit closer at how this political friction plays out in the real world. Following massive geopolitical shocks, like the invasion of Ukraine, trade volumes between adversaries actually plummeted by more than 6%. People literally just stopped trading physical goods with countries they didn't align with. But here is the crazy part. While the volume of goods dropped off a cliff, the prices of the goods that did make it through stayed surprisingly static. They barely reacted to the geopolitical tension. This is a huge takeaway, because it tells us that just looking at total trade value in dollars can totally mislead you. The real story here is the shrinking physical volume of goods moving between rival nations.
So, let's move into Section 2, Who Loses in Trade Wars? Because look, this fragmentation doesn't hit everyone equally. The vulnerability really comes down to 2 specific risks. First is the need for diversion. Basically, how much does a country currently rely on trading with its adversaries? And second, the impediment to diversion. If things go south, how hard would it be to find new, friendly partners to replace them? As you can see, European nations generally sit in the low-risk category for both. Meanwhile, heavyweights like the US, China, and Mexico, they are highly vulnerable on both fronts. Let's unpack exactly why those specific nations are so exposed.
For China and Mexico, their biggest trade dependency is the United States, which, going back to those UN voting records, is technically classified as a geopolitically distant partner. On the flip side, the US relies heavily on imports from its own geopolitical adversaries. The absolute biggest danger here, the thing that puts them in that high impediment category, is that their adversaries often outright dominate the global supply in critical sectors. Just imagine a sudden political shock where the US instantly had to stop trading with a rival for, say, critical battery components. They would find almost zero alternative suppliers available overnight.
Now, Australia is a pretty fascinating and terrifying case study in this data. On average, they're actually super well aligned with most of their trading partners, but they are incredibly vulnerable in a few very specific export sectors. For example, their largest export by value is iron ore, and the overwhelming majority of that goes straight to China, which is a geopolitical adversary based on the UN metrics. It's a huge wake-up call for global markets, right? A single, hyper-concentrated sector can expose an otherwise friendly nation to massive, massive geopolitical risk.
On the exact opposite end of the spectrum, we have Europe. European nations currently show incredibly low risk profiles. Why? Because they've essentially built this massive, geographically and politically aligned friend group. Around 70% of their exports and imports happen entirely within other European countries. Because they're getting their parts, labor, and capital from their own geopolitical backyard, they just don't have that same panic-inducing need to divert trade if global tensions suddenly spike.
All right, let's wrap this up in Section 3, the new rules of trade.
With the risks of trading with adversaries literally at all-time highs, how is the global economy adapting? Well, you've definitely heard of offshoring, but the new strategy taking over is called friendshoring. This is when companies purposefully pack up their supply chains and manufacturing, move them away from geopolitical adversaries, and place them squarely inside the borders of political allies. It's a very deliberate move to de-risk their supply chains from any sudden sanctions or political shocks.
But here is the catch, and it's a big one. This security comes at a huge price. Moving away from comparative advantage means you are actively walking away from the most cost-effective global markets. Economic estimates actually show that this inefficient use of labor and capital could cost countries nearly 5% of their real GDP. I mean, that is not a rounding error. That is a crushing economic penalty to pay, just for political peace of mind. And it's exactly why businesses are desperately trying to find a middle ground.
To balance those steep costs, a lot of businesses are turning to what's called the China Plus One strategy. Instead of a totally clean, wildly expensive exit, companies are running a three-step playbook. Step 1. Keep the highly efficient, already established manufacturing bases humming inside China. Step 2. Aggressively expand secondary supply chains into alternative, usually neighboring countries. And Step 3. Use that expanded network to mitigate the risk of relying on a single source. That way, if a geopolitical shock does hit, they can just flip the switch to their backup engine without having completely burned down their existing infrastructure.
And this whole fracturing effect, it's pouring gas on a few other major trade trends that are really going to define the next decade. First, we're seeing a massive rise in localized trade blocs, like the RCEP in Asia or the AFCFTA in Africa, which help entire regions boost interregional trade and dodge dependence on the usual superpowers. Second, the green industrial revolution is forcing a rapid pivot to eco-friendly supply chains, complete with renewable energy tech. Third, to keep whatever physical trade is left running smoothly, governments are heavily digitizing customs using AI and blockchain. And lastly, while physical goods are facing all these political hurdles, trade in digital services, stuff like software, consulting, and media, is absolutely booming, mostly because it's way harder to restrict with traditional borders.
Which brings us to the end of this explainer. And I want to leave you with a pretty heavy question to think about. The data is completely clear. The global economic order is absolutely shifting its priority away from pure market efficiency and toward strict political alignment. But as friendshoring and fragmented supply chains inevitably drive up costs and drag down global GDP, who is ultimately going to pay the price for this new era of security? Is the safety of a fractured, multipolar world really going to be worth the economic toll it takes on the average consumer? It's arguably the defining economic question of our time. Thanks for joining me on this deep dive into the data, and as always, keep questioning the world around you.